geopolitical tensions are back in focus. We entered a permanently higher geopolitical risk premium.
Possibility of tensions between US and China. This is the world reorganizing itself into blocks.
Whenever geopolitical tensions rise, oil prices tend to react immediately. Is this a temporary risk of move or a structural shift?
There is US dollar strengthening. Korea, Taiwan, China, they were like 10 to 12x.
Indian investor now a structural counterbalance to FII volatility.
This pool of money is largely untested.
Which sectors look more stable or promising?
While the AI disruption is for real, on sectors to avoid, I would avoid names which are.
What's the one thing most investors are getting wrong about this market right now? Hi, I am Devang Mehta, the CMO of Anand Rathi Group. Markets are volatile, FIIs are selling, oil prices are rising, and geopolitical tensions are back in focus. But the real question is, are these just temporary shocks or are we entering a completely new market environment? Today, we are breaking down what these global developments really mean for Indian investors and how your portfolio should adapt. So to decode all these questions, we have Neeraj Gaurh, who's the director at Anand Rathi AMC. He closely tracks the market macros. Welcome to the show, Neeraj.
Thank you for having me on the show.
Let's start with the big global picture. Geopolitical tensions have suddenly come back into focus across multiple regions. Historically, markets treat these as short-term shocks, but this time feels very different. Are current geopolitical tensions just creating short-term volatility, or have we entered a permanently higher geopolitical risk premium? And how should equity investor price that in?
Honestly, I think we should stop treating geopolitics as an event. Rather, we should look it as a condition. Last 30 years, the era of globalization, we saw unprecedented capital flows, which is reversing. Now, what you see tensions around Middle East, Russia, Ukraine, possibility of tensions between US and China, these are not isolated fires. This is the world reorganizing itself into blocks. For an equity investor, that means two things practically. One are the assumptions in your DCF, which you are building in around your supply chain. You need to revisit those assumptions. Secondly, the assumptions you have on the global diversification that is breaking down. So basically, you need to look at and you need to structurally raise the risk premium. So what we are doing right now is we are building 150 basis points to 200 basis points of risk premium for any of the global facing business. And I think given the context of the geopolitics conditions, appropriate.
Whenever geopolitical tensions rise, oil prices tend to react immediately. And for a country like India, oil is extremely important for macro stability. With oil prices elevated, how could this feed into India's fiscal math inflation and corporate margins?
India imports about 85% of crude, right? So there's no sugar coating about this. For every $10 rise in crude, it means about 15 to $20 billion hit into your current account deficit, right? So which is a big number. And above $100 of crude, it becomes a real problem. Now, the way it gets transmitted is basically three channels. One is your fiscal, where either government subsidizes it and bleeds, or it passes on to the consumer, which basically means inflation. If you have a higher inflation, is basically it constrains the ability of your central bank RBI to cut rates. And the third mechanism of transmission is your corporate margins. If you're seeing higher inflation and you're not able to pass it on to that extent, the margins for different companies, it could be paint companies, chemical companies, your aviation, those sectors will take a hit on their margins and profitability. All these three combined, you have a problem. But one thing which I would like to highlight is we are much better prepared what we were in 2013, right? We have got better buffers of forex reserves, so we're much better place than before, and our shock absorption is better. And as of now, our current account situation is also better than before. So yes, we have a problem in hand, but we are better placed to handle that problem.
FIIs have been net sellers in recent sessions, and historically, that has been a key driver of market sentiments. Is this a temporary risk of move or a structural shift in global capital allocation away from India?
I think it's both, and that's the honest answer. In short term, there is US dollar strengthening. higher or elevated yields in the US markets. And when that happens, EM or the emerging market as an asset class sees outflows, right? But that's mechanical and that's temporary, right? That's the short term outlook. But there is a structural layer underneath it because India was running high valuations for last 2 or 3 years. Our Nifty was about 22 to 23 times forward, while your Korea, Taiwan, China, they were like 10 to 12x. A part of that premium was justified, but the other part was also a narrative driven market, etc., which is self correcting. FIs are partly correcting that. The question is whether can India grow into its valuations? My answer is yes, but there is a pain in that journey as we get to that growth and justifies those valuations.
Despite FIIs selling, domestic SIP flow remains resilient. Is the Indian investor now a structural counterbalance to FII volatility, or is that a false comfort?
SIP flows crossing 25,000 crore is genuinely structural. This is a decade long trend of financialization of savings, which your COVID accelerated. But here is my caution, right? This pool of money is largely untested because you saw a lot of new investors post 2020, right? And they haven't seen a long bear market. So let's say if your market's correct by 20-25% and for a period of more than 18 months, then maybe you start seeing redemptions. So what I would say is your SIP money is a buffer, but it's not an airbag because you haven't seen how these people would react in a genuinely adverse scenario.
Indian markets have been trading at a premium compared to most emerging markets for quite some time. Is the recent market fall a healthy correction or the start of something more concerning, especially given how richly valued India was compared to peers?
My base case is that this is a healthy correction. Your small and mid caps had ran ahead of themselves, right? They were pricing a near perfect execution. So a 15 to 20% pullback is just kind of a normalizing your valuations. Nothing to majorly worry about. But I still caution on a thing, right? Is how we would look at earnings for next few quarters and considering if there are further global risk events, etc., how do they play out and how your earnings play out in those? So we need to be cautioned about that. But having said that, I think underlying structural growth story of India remains intact.
Different sectors react very differently to macro shocks. In the current environment, which sectors look more stable or promising? And are there any contrarian bets you'd like to make right now?
I like private sector financials. The valuation reset has been very significant while the credit quality remains pristine. I also like healthcare and pharmaceutical sectors. Domestic, consumption on that front remains pretty strong. The pricing in US generics market is more or less stable with a nominal deflation out there. And on the contrary, and this may surprise people, I'm selectively looking at IT related names, right? While the AI disruption is for real, I think market is pricing in too much of disruption too fast, and that's where you'll get your contrarian bets. On sectors to avoid, I would avoid names which are highly leveraged in the infrastructure space. So that's the one space we should be cautioned about.
Before we wrap up, I want to ask something slightly broader. Markets often focus on the obvious risks, but sometimes the biggest risks are the one people aren't talking about. What's the one thing most investors are getting wrong about this market right now? And what keeps you up at night that isn't getting enough attention?
What investors are getting wrong is conflating India's long term structural story with near term expectations. While India is a very strong structural story for next 10 years, your 18 months could be very disappointing, right? We can't mix both of them, right? The long term structural story remains, while your near term expectation should be moderate. What keeps me at night, right, is not about your usual worries like your FIs, oil, or geopolitics. We had a fairly good, robust earnings cycle over last couple of years. What worries me if we hit a earnings downwards revision cycle of 2 to 3 quarters, right? Then valuation will no longer act as a buffer. And still, when we look at relatively India versus other emerging markets and global markets, we're still not that cheap. So that's the risk I think which is still underappreciated is how the earnings pan out for next couple of quarters.
A lot of important perspectives there, from geopolitical risks to oil to capital inflows and sector opportunities. Markets are always uncertain, but understanding the bigger picture helps investors navigate volatility better. Thank you for joining us today and stay tuned for more such insightful shows.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.